Welcome to the deep dive. You've likely seen those headlines, right? Stocks just defying gravity, sometimes shooting up hundreds of percent in just days. Today, we're really plunging into one of the key mechanisms often behind those wild moves, something called a gamma squeeze. We're going to unpack the mechanics, try and understand the incredible power behind it, hopefully give you a bit of an edge in understanding these really rapid market shifts.
Yeah, it's fascinating because it shows how, seemingly technical things, these financial instruments, when they mix with certain market behaviors, can just unleash these huge forces. We'll try and break down how actions that seem small, like just buying options, can kick off massive chain reactions. It really reveals a lot about market dynamics.
Okay, so let's start there. At its core, what is a gamma squeeze? And what typically gets the ball rolling?
Well, fundamentally, a gamma squeeze happens when the market makers, the big firms like Citadel or Susquehanna that provide liquidity, they get sort of forced into buying or sometimes selling a huge amount of shares really, really quickly. This creates that rapid, powerful move, usually upwards. And it tends to start when traders, maybe retail traders, maybe institutions, start aggressively buying a large number of call options on a particular stock.
Right, call options. And when a trader buys a call, someone has to sell it to them, and that's usually a market maker.
Mm.
So how do these market makers protect themselves? I mean, they could face huge losses if the stock price suddenly just takes off.
Exactly right. They don't want that exposure. So they use a technique called delta hedging. It's standard practice. Basically, they buy shares of the actual stock to offset the risk from the call options they just sold. So the more call options that people buy, the more shares these market makers feel compelled, really obliged to buy to keep their own books balanced. And this buying, well, that's what starts nudging the stock price up.
Okay, so we've got delta hedging market makers buying shares to cover their options risk. That makes sense. But what turns that initial buying into a full-blown squeeze? Is there some kind of accelerant?
Absolutely. That's where gamma comes in. Gamma is the crucial accelerant here. Think of gamma as measuring how much that delta, that hedging need, changes when the stock price itself moves. As the stock price climbs and gets closer to, or maybe even goes past, the option's strike price, the gamma value actually increases, sometimes dramatically. This forces the market makers to buy even more stock and to do it faster, to keep up with their changing delta hedge. It becomes this powerful feedback loop, like a snowball effect. Rising prices lead to more forced buying, which pushes prices up even further, and it just ramps up.
Okay, that feedback loop sounds incredibly potent. Can you maybe give us a real-world example? Where have we seen this play out in a big way?
Oh, the GameStop saga back in 2021, GME, that's probably the poster child for this. You had retail traders coordinate on places like Reddit buying absolutely massive amounts of GME call options, often short-dated ones. This huge influx of call buying forced the market makers into that delta hedging loop we just talked about. They had to buy GME shares, lots of them. And that buying pressure helped drive the stock price from what, around $20 to over $300 in just a few days. It was astonishing. Plus, and this is key, GME had incredibly high short interest at the time. Some reports said over 140% of the float was shorted. So as the price rocketed up from the options hedging, short sellers were also forced to buy shares to cover their losing bets, adding even more fuel to the fire. It was a perfect storm.
Yeah, GameStop really puts it into perspective. So just to recap, what are the key things that make a gamma squeeze so powerful?
I'd say it boils down to a few things. First, that forced buying by market makers. They aren't deciding to be bullish. They have to buy to manage risk. That creates very strong demand. Second, that self-reinforcing feedback loop driven by gamma. The buying begets higher prices, which begets more buying. It accelerates. And third, these squeezes often happen in stocks with a low float, meaning fewer shares are readily available for trading. So even a moderate amount of forced buying can have a much bigger price impact. Less supply, bigger squeeze.
Okay, that makes sense. But with that kind of explosive upward movement, it sounds like there have got to be some pretty significant risks involved too, right? This can't just go on forever.
Absolutely huge risks. Gamma squeezes are inherently unstable. They're very short-lived phenomena. They can reverse just as fast as they start. If the stock price stalls or starts to drop, or even if just the intense call buying pressure eases off, then gamma works in reverse. Market makers need to sell shares to unwind their hedges as the stock falls or options expire. This selling can cause the price to collapse incredibly rapidly. So timing is everything, and getting caught on the wrong side can be brutal. These are definitely not sustainable long-term investment strategies. They're volatile short-term market events. You need extreme caution.
So maybe to wrap it up, You could think of a gamma squeeze almost like a, I don't know, financial hurricane. It starts relatively small, maybe just with a burst of call buying. Then it escalates dramatically as market makers are forced into that hedging frenzy, buying more and more stock. And it can reach this kind of crescendo, amplified by market sentiment, maybe short covering, just collective fervor. It really shows how interconnected and sometimes how reflexive markets can be.
Well said. And it highlights how these sometimes obscure market mechanics, these interactions between options and the underlying stock, combined with crowd behavior, can temporarily just overwhelm typical valuation metrics. It exposes, certain pressure points in the system. So maybe a final thought for you, the listener, to ponder. Understanding these kinds of forces helps you become a more informed observer, right? To see a bit beyond the daily headlines and makes you wonder, what other powerful, maybe less visible market forces might be out there shaping the financial world around us right now?